Welcome to RBC's Markets in Motion podcast, recorded April 13th, 2026. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, our 12-month S&P 500 price target remains 77.50, and we assume the index has put in a fragile, foggy bottom. Second, we run through our thoughts on what we're hoping to learn more about in the upcoming reporting season. Third, other things that jump out include how 2026 EPS growth forecasts for most sectors have been frozen since the start of the war, and the decline in consumer expectations for stock market performance over the next 12 months. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1, how we're thinking about the outlook for U.S. equities. Uncertainty in forecasting is unusually high and likely to remain so for an extended period of time. But with a messy ceasefire in place, we thought it was a good time to reflect on how we're thinking about the outlook for U.S. equities from here, focusing more on numbers than narrative. Our 12-month S&P 500 price target remains 77.50, a gain of 13.6% from the April 9th close. 77.50 is in line with the median of our outputs of our investor sentiment, valuation and earnings yield gap, GDP, and Fed models, with 3 of those models clustered around that number. Our models range from roughly 7,200 at the low end. That's from our GDP test, which reflects the typical return of 5.7% and a 1.1 to 2% real GDP environment. And our range goes to more than 7,800 at the high end. That's from our AAII sentiment test, which generates a plus 15% forward return signal based on the deep levels of bearishness that have been in place recently. Our valuation earnings model is also worth calling out. This model forecasts a PE based on inflation and interest rate assumptions and projects a fair value for the S&P 500 by combining that with an EPS assumption. It all signals fair value at the end of 1Q27 of 77.59. In this update, we did remove consensus macro assumptions, which have been frozen, and consensus EPS assumptions, which have moved up recently, and we frankly put in more conservative metrics. We haircut consensus EPS for the next 4 quarters by 5%, and on the PE, we baked in headline inflation of 3.3% in 1Q27, no Fed cuts, and 10-year yields that move up to 4.5%. The story this math tells us is that the S&P 500 can stay on a path to 77.50 over the course of the next year, supported by a recovery in investor sentiment from deeply bearish levels, a solid earnings growth and economic backdrop that don't incur too much damage as a whole from recent disruption to energy markets in the Middle East. Near term, we have commented that it appears to us the S&P has established a fragile, foggy bottom. S&P 500 and Russell 2000 valuations did stop looking expensive at the March low, but importantly, they had not fallen to deeply compelling valuation levels that were a reason to buy the market on their own. This is important because if the fundamental narrative around the war or its impact changes, there is room from a valuation perspective for stocks to fall again, perhaps more than they did before. That being said, as long as recession fears remain low, investors remain convinced the war will end soon, and earnings expectations don't take too much of a hit, we think the low is probably in. On positioning, we do have a slight bias in favor of large cap growth over value. We think U.S. equity market performance will reflect trends in earnings over the next 12 months, and the earnings story is simply stronger for growth and value right now. Bottom-up consensus EPS growth forecasts remain stronger for Mag 7 than the rest of the market, and 2027 Mag 7 EPS growth forecasts are showing acceleration versus 26, something we're not seeing for the rest of the market where the data is decelerating. We also expect energy market and Middle East disruption to weigh more heavily on the non-Mag 7 areas. While we don't have a strong view on U.S. equities relative to non-U.S. at this particular moment, we do continue to give a slight edge to the U.S., and that's also supportive of growth over value within the U.S. based on the history. We are also nibbling on small caps. Some of the positives we see for small caps include the strong March jobs report, continued improvement in ISM manufacturing, and the removal of froth from both Russell 2000 valuations, which returned to their long-term average in March, and small cap futures positioning, where CFTC data points to a slight net short in place but not oversold levels. Some of the negatives we see for small caps are the continuation of weaker earnings revision trends relative to large caps, a lack of optimism about Fed cuts in 2026 among financial market participants generally, and general concerns about the ripple effects of the war in the Middle East on the more cyclical parts of the equity market. Let's move on next to takeaway number 2, a quick recap of what we're listening for in the upcoming reporting season. Some of the specific Iran-related topics we'll be listening for include first, color on how much inventory companies have in stock for goods impacted by the conflict. Our recent transcript meeting has suggested some have 3 to 6 months, and any color on hedging. Second, assumptions on cost impacts from energy prices and other inputs. Third, how companies are managing supply chain challenges. Fourth, how corporate confidence and decision making have been impacted by the event. Fifth, how long the war and disruption to energy markets can last before it starts to impact corporate America. And sixth, whether companies are seeing any kind of material change in consumer behavior, and if so, within what cohorts, given elevated gas prices and the weak consumer confidence and sentiment readings we've seen in recent data. We do worry, based on what we've read over the past month, that companies will simply not have enough information to give investors about the war's impacts just yet. Beyond Iran, we'll also be on the lookout for color on tariffs and assumptions and insights into how AI tools may or may not be impacting company financials and specific use cases. And finally, let's wrap up with takeaway number 3. What else jumped out in our data last week? First, it's no secret that calendar year 2026 bottom-up consensus EPS growth forecasts have been moving up. Since the beginning of the Iran war, that improvement has been driven by the tech, energy, and materials sectors. Most other sectors have seen very little change on this stat, which could be setting us up for a reporting season with big moves, since it appears that very little has been discounted going in for most areas. And second, the most interesting stat to us in the 2 consumer confidence and sentiment releases that came out over the past few weeks was the Conference Board update on expectations for stock prices over the next 12 months. This stat has started to fall from extremely elevated levels, but remains well above the historical norm. This decline could be signaling that retail investors could be less aggressive about buying the dip going forward. That's all for now. Thanks for listening, and please reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.